Okay. Alright, let's get started here. Alright, so this webinar is basically going to be covering the current price action on the S&P, how we've come to it, and looking forward the next month or so, try to get an idea of how we want to play this market. So looking currently at the S&P on a 1-year chart, daily chart, obviously, reality is since 2012 specifically, we're definitely in a defined uptrend, and there's no denying that. However, there are some potential, lines in the sand that we have to go over to determine, how long we should be, or basically how much cash we should be holding as personal portfolio managers, because you don't want to be stuck on the wrong side of the trend, or the trade I should say, after the nice move we've seen. And for those of you who have been along for the ride since since the congestion period back in late 2011 when I was recommending buying, you should have nice gains in your portfolio. And towards the top, we had a few losing trades that I've sent out recommendations, and they didn't work out. But hopefully the recommendations, they should at least, the recommendations I made throughout the time the market was going up should have definitely made up for those losses and then some. So currently the S&P, I'm just going to focus on 2012 here. The S&P is at the bottom end of this current trading range, and we are failing. If you just look at technically, we're failing at what has been support, or what was support in late March, broke down in early April, and we've come back to test it as early, or I should say as late as today. So technically speaking, we're at the bottom end of this range, of this trading range, and in order to let the enthusiasm come back in some, you're going to have to see some type of push back above these levels and hold them for at least a day. One other thing to mention is there have been 2 times the selling volume has picked up recently. One was today, and the other was last Tuesday, which was the jobs report came out that Friday. And Monday the market traded sideways, and Tuesday the market then continued lower. So people, investors, traders at first bid the market higher today. Market open right here at 9:30, traded down. This beige level is a support level I have in the market. We bounced off that level, gave a push higher, which ended up selling back off, stabilized around this beige level, and actually had a nice push to the upside. And yes, that trade was profitable. If you were a day trader of the S&Ps, your entry should have, I know my entry was around 79 here, caught this breakout, nice little pop to the upside, take profits near the beige, and then we traded sideways, and obviously you can see pushed lower, found a floor at 1365 and closed at 1374. So pretty volatile day, 20-point range. Not that necessarily matters for people in this room watching this webinar, because most people are a little bit longer term. So the best thing I think I can do is just go into the monthly profiles and kind of go over what's been going on and see if we can develop a thesis here for the next 30 days or so and try to get some trading opportunities. So let me get a 2-hour chart. Okay. So what we've seen here in the past month, 2 months actually, is point of control 1340 in January, and we got a very nice trade off of that level and a push higher. The point of control for March forms at 1394. Jobs report came out and we pushed lower. The real trade was probably the following day, which was to get short and to see it flush. It flushed, and now we've stabilized since. So what's going on now? Well, we're trading against this high volume area up here, and we'll just focus on the point of control for March. And you can see, generally speaking, this level has been resistance. Actually, the value area high for the month of April, which is this 1389 level, has been resistance. And what's been support has been the value area low, 1360. You can also see back in March, you have high volume where before it tapers off, it ends at this 1360 level. Price has stabilized there for the last couple of weeks. Now we are bouncing off of this point of control for the last 90 days. And we got a 10-point bounce off of it so far. Now, one thing you have to keep in mind is people, investors, traders, given this range that we've seen from 1390 down to 1360 or so, they're going to, when shorts are pressed and we trade down below 1370, shorts are going to be reluctant to hold their positions overnight. So that's something that you have to keep in mind, which is why this market recently has been so, up and down range bound, is because you have people, traders, they've determined the range, and once price gets up to that range, they're going to be reluctant to be holding at those levels, and you're going to have short sellers coming in at the top end of the range trying to press it down, along with people who have bought the bottom or have bought, the trend going higher and are selling into the strength or up into that top of that range. So there's a little bit of, push and shove within this 30-point range or so, and your job as a trader is to determine, should I be trading this range? If the answer is yes, then basically you manage your risk accordingly. The market we are trading right now is not this uptrend market. It may return to an uptrend, but right now we're in a sideways consolidation, and you have to respect that as a trader. So one thing I'm going to do is zoom in a little more just to get an idea, because I'm not really sure. Okay, 30-day chart tells a little bit different of a picture because it excludes basically 60 other days. And let's just go back to show you. You can see the price action that we saw in February, and we're basically getting rid of that and just looking at the current 30 days to get an idea of what volume looks like at those levels. Okay, so zooming in, you can see this 1397 level on a 30-day chart. That's a very important level. I'm going to get rid of these drawings so we can see them better. That shows you where the most volumes has been taking place over the course of the last 30 days. Right now, on a 30-day chart, we're at the value area low. and there's volume here, but it's not significant relative to what's up here. So that, to me, in my experience, that indicates that you want to be a seller of this strength until we get back above this 1400 level or so. And that's just kind of how you have to look at it. As much as you want to, buy this 1360 level with expectations of a move to say 1450, that's not realistic right now. And if you're doing that, you're going under the assumption that the selling pressure that we've seen in the market over the last month or so is close to being exhausted, and the next leg of the uptrend is ready to start. I don't necessarily see that right now, but we could be getting close to something. We do have this 90-day chart is agreeing with that thesis, so it's something worth noting. It would be more bullish, in my opinion, if this point of control around this 1370 level, and it could do it overnight or going into tomorrow, forms at these levels, we stay above these levels, and then if we then push above or up towards this 1389 level, I would be more intrigued to see if there's more upside in the market. And the reason why is because not only for the last 90 days do you have the majority of the volume below you, but for the most recent price action, the month of April, you would have the price action, the heaviest price action in terms of volume, below you. Right now it's above you, above current price that is, and it's right to be a seller. And you can go back to last month, and the last month's heaviest volume is above you. So you just have to be careful. And when that happens, it's prudent to scale back on your longs, because the likelihood of more downside, or the possibility of more downside, is very possible. It's real, and you could give up some gains that you made since the end of last year, the beginning of this year, and those gains should be healthy. Let's look at the euro technically. What's going on here? You have the 200-day, no doubt about it, moving down pretty much at a 45-degree angle. Same with the 150. Even the 50-day moving average is capping any current gains. And that's just for a visual. That's not necessarily saying that the 50-day moving average is the moving average you want to watch on the euro. I don't trade the euro enough to really care, but I'm just pointing that out. You could also say that it's not getting above the top half of the channel. So what you're looking for here is if the euro starts to move higher and moves above, say, 133 or so, you could be looking at a pop in the S&P. This could be just a pullback until we see another high. But for now, it's more prudent to be sitting in more cash, only being involved in what's working, and letting the market, letting price action tell you what needs to happen. This triangle formation in the dollar, it matters, and I think if you find yourself over trading and losing money, or if you have found yourself over the course of the last week or so when the market has been in this range, it's not because you're a bad trader. It's because your strategy, which has been the buy and hold strategy, or which it should have been for the last 3 or 4 months, that strategy isn't valid anymore, and it could be it could become, I guess you could say, revalid, or price action could validate it once again. But until we see price action do so, you can't take the assumption. You have to trade what the market's giving you. And that's what's going to make you a very, very profitable trader in the long run. Does anyone have any questions? Do you think that the current trend is a bear flag? Okay. So what you're looking at is current price action. And I wouldn't necessarily, give me 1 second. I wouldn't necessarily call it a bear flag. But what you could call it, I guess potentially you could call it a bear flag, because we have a downtrend and then we have consolidation, and obviously if it falls down at the end of this, the potential for trend continuation to the downside can continue. But I don't necessarily look at it this way. I just see that this uptrend has spent 90%, maybe 95% of its time. Actually, it's probably between 95 and 98%, and you'll get where I'm going at in a second. In the top half of this trading range. Now, with the exception of one down day, which was followed by basically a resumption of the uptrend. Now, we don't have that. We have a breakdown, and ultimately, we kind of tested the breakdown, and we're waiting to see, does this roll over. You can classify it as a bear flag if you choose so, but remember, the bigger time frame players are probably looking at this 1340 level on the S&P, because it's not only the point of control for the year, it's not only the recent lows, but it's a pullback of nearly 6 to 8%. I don't know the exact percentage, and that could be classified to them as a healthy pullback, and it's time to get back involved in the market. Now, with that said, you also have to look at some other aspects that go along with that. Every day that moves on, or that time passes, this 150-day moving average will move higher. That will give buyers the comfortability that, okay, for the last 150 days, the average price in the market is X. And what is it right now? 1285. So in a month or so, that may be up towards 1300 or so. That would, people who use the 150-day moving average as a reference would feel more comfortable scaling into a position at 1340 with 40 points of downside to the 150-day versus buying at 1370 with nearly 100 points of potential downside. So, and remember, those are the bigger time frame players. Those aren't the people that necessarily look at the 20-day moving average and care what that's doing. Rather, they're looking at the broader view of the market, and they're trying to get in on bigger reversions. And I have to say, I do think that if this 1340 level is hit in the market, I do think it's going to be a buying opportunity for the reasons we talked about. The recent low, the point of control for the year. I think those are the two biggest things that you're looking at, and just combining with the fact that the market's going to be continuing, these moving averages are going to be continuing higher. Another thing worth looking at is the Volatility Index, the VIX, and the common talk is when the VIX is high, it's time to buy, and when the VIX is low, look out below. Well, this looks almost like an inverse of the S&P. If you look at the 50-day moving average, moving higher on the S&P, now it's a little, well, it's really right in the middle of price action. But on the VIX, let's see if I can type it in right. All right, on the VIX, what we've seen is resistance with the 50-day on the way down. We've had one positive close since the beginning of 2012, above the 50-day moving average, and every other day has been below. Until recently, when the VIX has bounced above this 50-day, and now the 50-day is support. So what do you look at? Well, similarly with the S&P, you're looking at this recent range in the VIX, 21 on the upside, and let's 1730 or so on the downside. The 50 days at 1740, so we can just call it that. Those are kind of that's your bracket, and I think if price is within that bracket, whether it's the VIX or the S&P, unless if you're day trading the S&P futures, or swing trading would be kind of tough, though there has been opportunity. This is a really tough market, and I have to be honest, my equities account has struggled more in the past month or maybe 2 or 3 weeks, than it has at all since October lows. And the reason why is because, I've been holding longs that, have been profitable, and I've been holding for a while, but you're in a position where people are starting to sell or press against those longs, or they're trying to get out of them, and therefore, obviously that brings down the price of things. So now conversely, my S&P futures account, where I day trade the S&Ps, that has been, this is the last 2 weeks or so, has been the best that I've traded the S&Ps since the beginning of the year. And that's usually due to volatility. When volatility increases, those day swings are greater, which is why you have to know your strategy or your plan as a trader. If you are a longer term investor, or intermediate term, 2 to 3 months, the move that we've seen in the S&P, that's your move, and you should probably be walking away from the screen and not really paying attention to the market unless the names you are holding continue higher. Now, that's not saying that there aren't opportunities, because there always will be, but they are few and far between. Whereas the first 3 months of the year, you could buy wherever you wanted, and 2 or 3 days later, that position was sitting in a nice profitable situation. So you have to take your shots, and right now in the market, the shots are getting those swings on the S&P futures. Just to put in context, trading these S&P futures, these 10-point swings, if you're trading one contract on 10-point swings, it's $50 per point on the S&P, so you're pocketing $500 on $1,000 worth of margin. So that's just something to consider. Now, I'm not recommending going out, opening up a futures account and taking a stab at it, because you'll lose money. But if you establish a plan and realize when the volatility is high, I can make money a lot more easy in the futures market than the equities. Okay, Apple continues to get tossed around. The volume has increased substantially over the last 4 or 5 trading days. I'm going to bring up the weekly chart, and you can, point of control for the week down at these lows. So we'd be looking for a bounce at this 587 level. But then again, for the last month, 600 should be some type of resistance. So just be aware of that. Really, this is something that I barely have any exposure in now. Just a small placeholder position. so I can stay involved. Alright, Medifast, this is a name that I recommended when it was starting to break out or it was close to breaking out. And the reason why is because the PE, the price earnings multiple, is 13, which is about market value. But the difference is between Medifast and the S&P is Medifast has a 52% growth rate. On top of that, there's a short interest which equals 12 days to cover. So it was poised to get this type of bounce, or breakout I should say. And you can see it was also against the point of control of the year, around $17, and all the moving averages were underpriced. So everything set up very nicely for this type of move. And when you're patient enough and wait for these types of moves, they can be very profitable. And the reason why I sent out an email 2 days ago on the 17th saying I took profits right under $20 is, yes, it went up another 50 cents, actually 60 cents above where I sold. What caused me to sell, and all I did was do some Fibonacci retracements, which I really don't do much, but considering if you're looking at the volume profile on the right here, there's really no volume until you get to 23, 24-ish, and very rarely does price go from 18 to 23 that quick in one straight line. So one other thing that happened was value area high around 20.79, 17 cents off of the highs from let's see, Tuesday. So let's look at what's going on here. We had a 50% retracement, which was right around $20. That's why I took profits where they were. But on a pullback around 18, maybe we get another opportunity here. So we're just going to have to wait and be patient. Agrium held up nice today relative to the rest of the market. Up nearly 1% today, and yes, that's something worth noting. Also, on a chart and the most recent price action, we like to see point of control after a nice move to the upside and a pullback. We like to see point of control at the bottom end of that pullback. Usually represents some type of opportunity to buy the dip mentality and see this go higher. Also, the 200, 150, and 50-day moving averages have been resistance, and now prices above all three. That should be worth noting, and just kind of go from there. CVR Partners, another name that outperformed today, up 2%. We were covering this when it was below 27, so you have about 4% gains here, and you're looking for more upside. The volume here was nice, pretty good volume today, especially relative to the last 3 days or 4 days, ish. So what we want to see now as buyers is a break above this 28.30 level or so, these recent highs. That'll give you the indication that this isn't just light consolidation, and we're going to go see if the buyers can press it back up towards the 31 level. CVR Partners, this company, has a 14 PE with a 34% growth rate, and they have a return on equity of 30%, and they pay an 8% dividend over a year's time, so not too bad. Pfizer, I recommended this a couple of days ago when it was at the 50-day moving average, so you can define your risk, place your stop under. Actually, the stop was actually around 21.60, where this black line was. You got paid to put on that trade, and now your stop should be at break even, and you should be looking to see if this continues to press higher. Just like any trade in the market, I wouldn't want to see this come back and basically give you a loss after it's been a gain. You can also see the amount of volume that we are seeing from 22 down to 20 or so, but most significantly, or most recently, around 20, well, we'll call it 2050, 2060, which is the point of control for the year. Pfizer's breaking above that, and we've come back to test it, and what looks like for now a successful test. Kind of looks like Celgene, when it was consolidating, broke out, came back to test the breakout, and has continued higher since. So it's just something worth noting. I know Pfizer is like a 4% dividend or something. Travelers. When the Dow was the only indice that was up a couple of days ago, I was looking at all the Dow 30 to see, what looks like, potential opportunities. That was on the 16th, Monday. I believe it was Monday. And what we've seen since is a breakout to the upside, up nearly 4% today. This is a breakout, and what you're seeing is a breakout from the point of control for the year, $58.50, and we should see higher prices. I'd be looking at these recent highs, 64 or so, as a potential selling point, but at the same time, if you zoom out, this is a name that has been, although a sloppy chart, you've had basically two areas of congestion, from 52 to 47 or so, and then from 60 to call it 57. And you've had a decent amount of volume at those levels, and now you're looking for a continuation higher. So if this is one big sideways consolidation, we could see a continuation of the uptrend and see new highs on this. Just don't, it's a slow mover, so you're not going to get rich overnight doing this, but it's decent, and it's definitely paying you to be long. RIM kind of continues to work off of these lows, still hasn't made new lows, which is good. Just one that I still think you want to manage to be long. Looking at the chart here on at these this profile, 90-day profile, I want to bring it in some. You see 90 days, we have point of control, a little bit of resistance here. You can see it's been a pivot. This 1375 level, 1368 is the point of control for the 90 days. You can see just for the last 2 months, nope, not like that. Alright, just for the last 2 months, it's been a level which you could trade off of. So now we're here again. What you want to see is a breakout above that level, a test of 1475 or so, which is the top end of this range. That gives you the indication that maybe this sub 1375 level is considered too cheap on RIM, and you're looking for more upside from there. Another thing to look out for, you still have the 50-day pointing straight down. It was a place to sell when we actually put on that original trade, the 15 by 18 call spread. But it's, it does look like this is in the bottoming process. It kind of reminds me of Netflix, which came in for a landing and then pushed higher. That's kind of what I'm looking for with RIM, actually. So it's just going to have to be a wait-and-see approach. Cliffs Natural Resources. This is one that I think I'm going to put a bearish trade on come earnings, which are next week, and see if we can make that work out. I nearly took a shot at the short side today when it was down about, I think less than 1% or so, and I chose not to. I'm just going to hold off and wait till the day before earnings. If I choose to send out, if I choose to put on the trade, I'll send out a message if you guys want to join. But that's just something worth noting. Walter makes a new intraday high today, higher close than what it has since it's bottomed here. The trade, it's volatile, but the trade's working. However, I'd be careful. It is at the top end of this range, and if the market rolls over, I'm sure Walter will too. So let's look at gold, which continues to hang in there. That kind of looks like the market just the S&P just consolidating. What we want to see from gold is, from the long side, if you want to be a buyer, is a close above 1660. That will clear it from this recent congestion. And from a selling standpoint, you want to see it start to roll over and break this 1630 level or so sooner rather than later. Now, with that said, the cheaper gold goes in price, the more people who believe in the gold story are going to want to buy it. So just something to be aware of. And the last name that I'm interested in covering is silver. And silver continues to hold these lows here. It may be ready to pop to the upside. I'm getting tempted on initiating some type of call spread on the SLV, but I haven't done so yet. Looking at an hourly chart, we are now above the last 2 months point of control, meaning this month, last month, and the point of control for the last 90 days. I think this is your opportunity in silver if you're looking for a trade in silver. SLV, you'd be looking at the at-the-money call 31, and you'd be looking to sell the 33 call against it or so. And what we can do is we can pull up that price or that trade, that spread, and you'd be wanting to go out to May. Give this a little bit of time just in case. And actually you can do, if you want to go a little more in the money, you can do the 30 half calls. That may be prudent. And so you'd be looking at a trade, you'd be buying the 30 halves, and we'll sell the 32 halves because it's a little closer to that 50-day. Let me get a spread. Let's see, 2 months, 3 strikes, vertical. No, I don't want to roll it. Okay. 30 half, I gotta go one more strike, bear with me here. 4 strikes, vertical. Alright, 30 half by 32 half. Trading for, I want to buy it. It's trading for 78.79 cents. So essentially you're going to spend 70, well, if you put on one of these, you're going to be spending $80 to make a potential of $2, $2 flat. So not necessarily the best trade in terms of payoff, but about a 1 to 3 payoff isn't too bad, and you're just looking for a pop to the upside. So wait for silver to confirm that it's wanting to go higher, and you may have to pay a little more for this, but overall I think this is kind of the direction you want to look if we do get a pop. Now this is going to totally be negated if the thesis in the dollar, which is a potential for an upside breakout, works. That's going to negate this silver trade. So you may just want to hold off on it, or you'd be kind of flipping the dice, or not flipping the dice. You're going to be flipping the coin or rolling the dice, and I don't necessarily think that that's something that you want to do. So really, that's it. Do we have any questions? I see that